Let's take a look at the S&P 500 on a weekly chart. And the point I want to hit home on is this market has been a mess the entire year, essentially. I mean, look at this price action from earlier this year, all the way through summer, then the recent plunge, and then the rebound consolidation. I mean, this has been a trend trader's nightmare. And if you're using like a tool such as my stage analysis screener, you've known that there hasn't been a lot of sectors breaking out all year, and the S&P 500 and the Nasdaq and the New York Stock Exchange have all been relatively weak the entire year. So this is what's led to this very choppy sideways price action that's very similar to what happened in 2011. Um, Now, commenting on recent action since the August plunge, we have seen the rebound to the 30-week moving average that I was expecting, and this has occurred over an 8-week time period. So people have become less and less bearish as the market has rallied a couple hundred, 100 or so points back up to the 30-week. But the question is now, where does it go from here? If you look at my stage analysis screener at screener.nextbigtrade.com, if you look at the markets page, you can sort sectors by percentage in stage 1, stage 2, stage 3, and stage 4. And really something to hit home on is that the the amount of sectors that are actually in uptrends right now are still the kind of the weak defensive sectors. For instance, like government bonds, REITs, and utilities are kind of like leading the market right now as far as the number of stocks they have in uptrends. And short index ETFs still has 50% of those ETFs in my list in an uptrend. So even though the market has rallied since August, this market is still very defensive and very weak. And anyone that's like recommending long positions right now in this market is just kind of a fool, because the general trend of the market is disagreeing with what they're trying to do, which is going to put pressure on their long positions. I mean, very few stocks are actually making new highs right now. Only things like Nike, Facebook, Amazon.com, some of your large cap leaders from this entire year are the only stocks that are making new highs. Um, if you look at, if I sort this by alphabetically and go down to um, U.S. markets and U.S. sectors, these are two very important things to look at. And if I look at the U.S. markets page, we can see that only the Nasdaq is in stage 3, and the rest of the major index ETFs are still in stage 4. So this is a signal that tells you that to still stay away from the market, because we're still in a stage 4 downtrend for most of the major indexes. And if you look at stock market sectors, you can see that technology is kind of broken back into a stage 1 base because it's rallied up to its 30-week moving average. And consumer discretionary, consumer staples, and utilities, two defensive sectors right here, have actually broken back above the 30-week moving average in a kind of an early stage 2. But they really aren't, they've really just kind of rallied back from that August plunge. So, overall, the market is still very weak. And actually, if you're thinking about taking a short position in the market, it's getting really close to being a good time to do that. Um, One thing I'm looking at is, financials haven't recovered the 30-week moving average, and anytime the market as a whole is in a uptrending phase, you typically see financials join along. Even though they might underperform other sectors, they still kind of go up in an uptrend. So the fact that financials still haven't recovered the 30-week moving average is another sign that tells me that um, the market's still weak. If you look at like staples and utilities that I was talking about earlier, you can see that they've just gone sideways the entire year, had that smash, and then they've rallied back above here, but they're still not really doing anything too constructive, and this is just defensive money that's rotated, into this sector. And same thing with utilities. They actually went down for most of the year, and then they've had this rebound rally since August. So market is still very defensive. One other thing to look at is the S&P 500 percentage of stocks above the 50-day moving average, and we can see that since the August smash down around 5%, now we're up to almost 70% of stocks in the S&P 500 are now above the 50-day moving average, which is very important because now, most of these stocks are now in a short-term time frame technically overbought, which means that if they don't receive any more buying pressure going forward, we're going to have another down leg in the market. So, we're getting close to like the 75% level that I was looking for, and since we're coming up to resistance too on the S&P 500, I wouldn't be surprised at all to see another smash down in the major indexes, any day now, really. The only caveat to what's going on in the stock market is that we're coming up on a seasonably somewhat favorable period. So, typically till the end of the year, you can see that, Christmas rally, but earnings are really bad right now. So it's kind of left to be seen, whether the market can fight through this resistance or not. But it's definitely a good time to enter again on the short side if that's your bias. So I hope this provided value, and thanks a lot.